Okay, I think this is now being recorded. Okay, so we're going to get started over here. Welcome everybody to listening to this Zoom call on the private shares fund and how it can give you access um, to pre-IPO investments like SpaceX. And I've been dealing with the private shares fund for a number of years now, and the reason I wanted to have this talk now is because I think it's particularly timely to be talking about this. So we're gonna let Kevin. Um, yeah, he's the one who's the manager of the fund. He's going to be giving the presentation, talking about the fund and the way it works, and then also talking about why now. And then, feel free after we go through that part of the presentation to ask any of your questions that you might have. Okay, Kevin, do you want to get started?
Sure. Thanks, Steve. Great. So what I think what we're going to do is just kind of get a little bit of a backdrop on the fund, why we started the fund, um, go through some of those slides. I'm not going to hit on every slide in this presentation. I'll bounce around a little bit, but I want to get to a point where we can get the background and then why it's a particularly exciting time right now, and then maybe take a look at the portfolio, especially for some of those that are invested in the fund.
And in particular, and if anybody's interested, the presentation that I have here, it can be available to you as well if you wanted to see some of the slides.
Exactly. So yeah, Eric, if you just punch it to the first slide, the first couple slides really are predicated on this idea that companies are staying private longer, and really it's just underscoring this idea that the majority of growth that's happening in companies in equity right now is happening in the private space. And what this is showing you is that if you go back 20, 25 years ago, companies' average age before they went public was somewhere around 4 years old. So a company like Apple would go public. They're doing, call it $150 million in revenue. They're growing 30 to 40% top line. And a company like that would have to go public in order to finance its growth. And at that point, people like you and me would be able to invest in those companies and participate in all the appreciation that they received over decades. Today, however, a company with that kind of profile stays private for at least another 10 to 15 years. And if you look on the right side of this slide, it kind of shows you the graduation over time. For companies like Apple, Adobe, Cisco, Amazon, these were companies, again, that were going private after they were 3 to 4 years old. And then through the years, you can see they stayed private longer and longer and longer. And so the question began to be asked, like, how do you get access to these companies? Well, yes, if you want to get access to this growth, you do have to tap in to the private space. And if you go to the next slide, Eric, just to kind of continue on that theme, you might be surprised to know that companies that are generating over $100 million or more in revenue, 75% of those companies are private. So a massive amount of, growth, AUM, private growth is all taking place in the private space. There used to be one unicorn, which we know today as a company that's valued at more than $1 billion, and that was Facebook back in 2010. So a simple illustration of this shows that today there's well over 1,200 unicorns. So again, just an enormous amount of growth in these kinds of companies. And so how do we tap into this growth? If you just click to the next slide again, Eric. And this kind of is what this is showing you, is that people like us, the ordinary investor, especially if you're not accredited, we never had access to the private space. We still have a hard time getting access to the private space. Most of the institutions and family offices and things like that, they were the ones that were able to get access to these kinds of opportunities. They could get into the big venture capital firms. They can get into the big private equity firms, the hedge funds, things like that. And by comparison, advisors that are managing money for ordinary investors, whether they be accredited or non-accredited, had a very small allocation to the space. And that exists today. And so we're trying to figure out ways that we can, get access to these companies in a more investor-friendly way. And we'll talk about a little bit about some of the pain points from investing in traditional venture. Next one, Eric. Yeah, and this again just shows you, family offices are looking to significantly increase their allocations to alternatives in 2024. I mean, it's not just them. It's institutions. It's large multi-billion-dollar RIAs. You're seeing funds like ours, these semi-liquid strategies, pop up now all over the place. We launched our fund almost 11 years ago, and nobody was coming out with a structure like ours, the closed-end interval structure, which I'll speak to in a second. But we were one of the very few, and we were the only ones that were doing it in private equity. A few of the others were doing it in real estate, some in credit and things like that. But today, now there's a lot of allocations going into these semi-liquid products and alternatives. And this is a great illustration. You can talk for a long time on our strategy and the space just on this. This is sort of a picture of the J curve. Traditional venture, if you look up at the lower end of this curve where it says startup, that's traditional venture. That's where you have a couple people in a garage, comes up with a great idea. They go to Sand Hill Road here in Menlo Park in California, and they go up and down Sand Hill Road, knocking on doors for the best and most successful VCs there are and try to get funding for their idea. They come with slick presentations, and they're hoping to get that kind of funding. These are startup pre-revenue companies with a lot of technology risk. So that's not what we do. That's traditional venture. And as you can see here on this curve, 25 years ago, you'd have a startup like this. And as we just described, the small mid-cap area would be a public company. At the end of that first break, after startup, that's when you used to be able to invest in these kinds of companies because they'd be public. But today, that's gotten moved all the way up to large cap. So now these companies are staying private for much, much longer. They're becoming bigger, more mature companies. And that middle area is where we participate. We call it, growth private companies or late stage venture. Venture being that we invest in companies that are more mature than early stage or pre-revenue companies, but we want to see them backed by some of the more successful VCs because there's a lot of benefits from that, and you're going to see it in a slide later on. We invest alongside a lot of the more successful VCs. We want to invest where these smart investors that have a track record of success, that are managing the company, that continue to finance the company, and they've already done a ton of due diligence before we actually get into it. So in our case, we want to hit that middle spot. That's our sweet spot in this particular strategy.
Yeah. Kev, if I can add something just very quickly, a common question that we continue to get is, why are companies staying private for longer? Like, what is actually really driving this trend? There's been books written as to why this phenomenon continues, right? The private for longer story. We like to bullet point kind of three that we think are probably most critical. And the first being is that it can be difficult to becoming a public company. It's expensive, right? It's a massive administrative burden. Two, if you're the management team of a private company, and like Kevin said, you are obviously exhibiting high growth rates, you're generating real revenue, at least as far as the type of venture that this fund is targeting. Why would you want to be susceptible to the volatility of the public markets? And therefore, the management team might be influenced to make shorter term business decisions in an effort to make sure, as a public company, they're not missing quarterly earnings estimates, or they're not lowering their guidance. Because if they do so, that may hurt the public stock price. And third is access to capital, right? 20, 30, 40 years ago, right? The likes of an Amazon or an Apple or a Dell or a Cisco Systems, right? Names that we're all familiar with, names that many of you on this call may be invested into, were almost forced to go public in an effort to raise a certain amount of capital so they could continue to finance their growth. Well, that same profile of a company today, right? A couple of years ago, like an Uber, a Spotify, and a Palantir, right? Companies that I'm sure you guys are also familiar with. These companies weren't forced to go public to raise capital because you saw a proliferation of accessible capital via the private markets. And so this is what continues to really, as you see on the slide here, push out the exit, push out the IPO. And so for an investor on the retail side, that meant that 20, 30 years ago, you could have bought, right? Again, I'll go back to an Apple or Amazon and participated in the exponential growth as those businesses grew from a startup valuation or a micro cap to a small cap to a SMID. Well, today, as companies stay private for longer, as Kevin outlined well, a lot of that growth and a lot of that return is now being captured in the private markets. So I hope that's helpful.
Yeah, yeah, and just to put an exclamation point on that, it's really the ability to raise capital in the private space. The regulatory environment changed. That forcing mechanism that required companies to go public in order to raise capital to finance their growth. A lot of that changed due to the regulatory environment, especially the Jobs Act in 2012 by Obama. There used to be this idea that you would have a cap table with 500 people on it, 500 investors, including employees, before you had to be able to actually show your financials and be forced to go public. The Jobs Act changed that to 2000, excluding employees, which gave these smaller businesses a ton of flexibility. And to Eric's point, like if you're not ready to go public, if you don't, you really don't want to go. Companies do not want to be public companies until they're very ready to go public for all the reasons that Eric just stated. And so regulation make it a lot easier for these companies to stay private a lot longer and tap into capital that they wouldn't normally raise if you looked at them back 20, 25 years ago. But if you go to so that's what we were kind of trying to handle. And if you think about the pain points of traditional venture and private equity, the typical investors, as we stated, institutional investors, was that appropriate for your normal retail investor, people like us, to invest in? And there was a lot of pain points in that regard. And one of them was fee structure. You had this 2 and 20 fee structure in traditional venture and private equity. That back end fee, that carry, was something that we wanted to eliminate as we were going through what the actual structure was going to be. And we spent about a year to a year and a half talking to people just like Steve that manage clients' money and trying to get access to this type of asset class to come up with this kind of structure. So we wanted to eliminate the back end of the fee structure of traditional venture. Obviously, access was a big deal. Nobody had access to these types of funds, and we wanted to democratize access to the asset class. Liquidity, operational efficiencies and things like that. Liquidity was a big part of that. Typically in venture and private equity, 10 to 15-year lockups, that wasn't really appropriate for a ordinary investor, especially when financial advisors trying to rebalance their portfolios or just give them some liquidity because of a life event that comes up, buying a house, sending kids to college, things like that. And the administrative nature of actually investing in this asset class was extremely onerous. We wanted to fix that too. Obviously, broad exposure, experience, like that's what we came with. I think our team, but those were some of the big pain points. And what you see today with these semi-liquid products, believe it or not, one of the smarter things that the SEC did was design the structure that was made for illiquid assets like private equity, real estate, credit, and others. And that is the closed-end interval fund, which was designed within the Investment Company Act of 1940. It's been around for about 30 years, very underutilized when we came across it. But that's exactly what it did. And if you look at it today, which a lot of people are now using and understand the closed-end interval structure, it operates just like an open-end mutual fund on the way in, where you're buying it every day at the end of day NAV. No difference than buying a mutual fund. You have regulatory oversight. So that was, that's the way it works on the way in. On the way out, though, it's quarterly, as we all know. And we thought that was a pretty good way to manage in a liquid asset, but still get the kind of exposure and growth that we were looking for. Every quarter, we open up a window and we allow people to make redemptions, and we cap that at 5% at the fund level, not at the investor level, at the fund level. And so we've had some pretty good success over the past 11 years with that type of structure, and other interval structures of interval funds have done well with that as too. So those are two important features. The fact that it's a publicly registered fund, comes with a ticker symbol, that avoids all the paperwork that comes with traditional venture and private equity, the PPMs, the subscription documents, the transmittal letters, all of that, the legal costs that go into that. We eliminated all of that by wrapping this into a closed-end interval structure or a publicly registered fund. Comes with a ticker symbol, full transparency, quarterly filings. You get what you see, and so this was the direction we wanted to go into. And that really thought, in our mind, we thought we were eliminating a lot of the pain points. Didn't know in the very beginning when we launched the fund if that was going to be successful or not in terms of this structure for private equity. But here we are now, 10 years later. We launched the fund in March of 2014. I only launched it with $100,000 of my own money and my partner. And now we've raised over, $1 billion since then. 10 years later, we've invested in over 200 companies. We've had over 60 exits. A lot of the companies, of course, you recognize, Pinterest and well, these are in the portfolio now, but Pinterest and Lyft and Uber, Spotify, those were all companies that were in our portfolio. This is our portfolio as of today. We've got 83 companies in the portfolio, and some of these you're going to recognize, of course. SpaceX is a name of note. And actually, when you look at this holdings report, the biggest companies are from the upper left-hand corner all the way down to the right-hand corner. SpaceX is going to become our largest position because I'm assuming everybody saw the news that they just did another tender round where they're allowing their employees to sell shares to investors at a $350 billion valuation. Last, they were doing it at $211 billion valuation. So I think Elon Musk, with his momentum that he has right now, took the opportunity to really increase the value here. And so that's going to be our largest position as soon as we make that adjustment, which is actually going into the portfolio by the end of today, because we got confirmation on that. So you'll actually see in real time how something like that will affect the performance of the portfolio. That's a $60 million position, which is going to become about an $82 million position in the portfolio, because we're going to have to write that up to the new valuation. That then filters into our NAV at the end of the day. And so you should end up seeing somewhere between a 2+% move in our performance by the end of the day. And you'll see a few other companies get adjustments as we come into the end of the year. So SpaceX, a company like Nanotronics, which is an AI company, manufacturing company, they're working on a round right now. Company like Betterment as well. More than 50% of these companies that you're looking at right here are public ready companies. And I think this starts getting to what the opportunity is. And in terms of timing, as sort of Steve intimated at the beginning of the conversation, we've just gone through 3 years of a pretty challenging market in venture and private equity, especially as it relates to valuation. And the exit environment has practically been shut. And if you look at this portfolio, SpaceX, Betterment, Motive Technologies, one of our larger positions, Arctic Wolf is a cybersecurity company, Discord, Lime Scooters, which is the largest scooter company in the world. A company like Upgrade, which is a lending platform. They do 800 million plus in revenue. They're profitable. Grub Market at the very beginning at the upper left, $3.5 billion in revenue they're going to do next year. This has been a public ready company for the past 2.5 years. Databricks, which you've probably recognized, and many other ones here. They're all public ready companies. We were having a little conversation before we started the webinar about profitability. A third of these companies are actually profitable, which is unusual. Most of these high growth companies are not profitable. And you'll see them go public, not profitable, but you want to see the growth and the view to profitability. And so the opportunity as we see it, and we've seen a shift in this market, companies are starting to raise capital again at higher rounds. The dislocations that we've been seeing in pricing over the past 2.5 years, which was the opportunity that we took advantage of, and we've added to a lot of these positions at really good companies at really dislocated pricing. So that's what's been keeping us busy over the last 2 years, waiting for this exit environment to open back up again, so that we can get an additional boost in performance. And I think a lot of value is going to be unlocked because of that. And so a lot of these companies you're going to see head to the exit in 2025, we think. You're seeing some of the dislocations go away, but there's still a lot of embedded value in the portfolio. More than 50% of this portfolio is still held below last round by a factor of like 50%, last round financing. So there's a lot of embedded value in here. And so once this exit environment opens up, and who knows what the catalyst will be there, could be a company like Cerebras, which is in our portfolio, which is a NVIDIA comp. I mean, given that there's so much excitement around NVIDIA and AI and those types of companies, I mean, Cerebras was last valued at 4.4 billion. This could be a 10 billion plus IPO, and it could be the type of IPO that sort of sends off that signal to other companies, hey, it's safe to come back in the water again. And we're seeing a lot of signals as it relates to that. So we're excited about that. Yeah, go ahead.
Yeah, just to add to that, right? When you look at this fund, you look at how this asset class, and particularly this fund, generates returns, we need capital markets activity. What does that mean, right? Fund needs exits, whether that's an IPO or it needs some sort of M&A transaction. That has all been basically frozen up the last couple of years. Be it that, well, at least Steve is located in Florida. I'm assuming some of you may be in Florida as well. There is actually a study published by a professor at the University of Florida, and it's pretty straightforward. It simply just looks at the number of tech IPOs going back all the way to 1980, right? And this is all public information. Steve, I may have shared this with you, but you can kind of see the ebbs and flows of different cycles here, right? So in the dot-com era, right, you had over 425, 430 IPOs, right? A lot of companies that probably shouldn't have potentially IPO. Then you have 08 and 09, right, where there were only 10, right? That speaks to obviously the difficulties surrounding companies going public during the great financial crisis. But I think what surprises some of the advisors and clients that I speak with is that we actually have seen less exits and less IPOs, particularly in 22 and 23, where there was combined 5, than we did in 2008 and 2009. That speaks to the environment. And that also speaks to, I think, what Kevin and his team have continued to be discussing with us, is that there's this historically large backlog of IPO-ready private companies, right? Like Kevin mentioned, Grub Market, our top holding, has been public ready for 2 to 3 years, but they're not going to force an exit, right? They're going to be thoughtful around when they're going to maybe push for that IPO. So when you take a step back and you think about what's going on today that wasn't happening a year ago, 2 years ago, 3 years ago, well, one, public markets have performed really well over the course of the last couple of years. So you have these private companies that are looking at competition, their public peers, they're trading at all-time highs, multiples have expanded. 2, interest rates. Interest rates have been cut, right? Versus in 2022, the Fed was going through one of the most aggressive hiking cycles since the 1970s, right? Public markets rolled over. That is not the time for a private company to go public. And 3, I think it's fair to say that the new administration coming into place will be more pro-business, right? They ran on a platform of deregulation, right? Not to get too political, but that should bode well for this space, right? That should bode well for a pickup in M&A activity, as well as I think it will usher in kind of this new wave of an increase in IPO activity. Kev, do you want to add anything to that?
Yeah, no, that's exactly right. I don't think we have the slide in this presentation, but the IPO backlog in the 25 years that I've been doing this and potentially the history of equity markets has never been bigger. And that's sort of the opportunity that we're looking at. And you think about, a coiled spring right now, like the longer that it goes on without an exit environment opening up, the bigger the backlog becomes and the more explosive potentially the exit environment is. And you're seeing it, as Eric, pointed out, you're seeing in the public market. For a long time, the big rally was behind the big seven, big tech companies. But small cap companies, you saw the high growth companies, of special financial technology, and companies like that, they weren't rallying at all. But you've just seen that happen over the past 2.5 months, them absolutely rip. And these are a lot of the companies that signal valuation changes in high growth private companies. And so already you're starting to see some of our companies getting written up a little bit more. The signals are all there. And so, no, is it going to be a valuation environment like 2020 and 2021? Who knows? But we don't need that. We just need a regular and healthy, sort of like a 2018 exit environment for us to really benefit and unlock a ton of value in our portfolio. So if we end up this year performance-wise, 9 to 10%, we're sitting at 5.6% right now. Well, we only have 3 weeks left, but there's potential for us to end the year, probably twice that amount. But the real returns should be coming in 2025 when a lot of these companies exit. A company like Grub Market, which is going to have a $3.5 billion in revenue and is trading at less than a 1x multiple, and you have all comps that you can compare it to at 2.5 to 8x. Well, when it goes public, that's where they're going to try to price Grub Market. Right there, that's a 2 to 3x from where we're holding it. Now, even if they don't price it, they've priced it at the lower end of the range. That's still a good valuation move for us. A company like Motive Technologies, their closest comp is Samsara, one of the hottest companies in the public market right now, trading at around a 27x revenue multiple. It's kind of crazy, but we're holding Motive at 7.5x. That's kind of where we're holding it in the private space. So a lot of embedded value there. That's a company that also is public ready and wants to go public. Where are they going to price it? Are they going to price it at 27x revenue multiple? Who knows? But do half of that, and that's still a double for us for Motive. So a lot of companies like that are sitting in our portfolio.
Yeah, Kev, just to add something, obviously we've all been very pleased with how public markets have performed, right? I'm an investor myself in public markets. But a question that has come up more recently with advisors like Steve is how sustainable are these returns, right? If you look at the S&P 500, right, the multiple right now is at 24, 25 times. The average is 16 to 17 times. So when you compare public markets and valuations of multiples in public markets to then our portfolio, right, we really believe there is embedded value inside of private markets, and particularly the private shares fund. Our multiple has basically been cut in half and has sat there, right, since peak levels in 2021. So very different movement within private markets, because again, to generate returns in the private shares fund, we need IPOs, we need M&A activity. So while we haven't seen that, portfolio fundamentals have continued to grow, right? So our portfolio companies are trading at all-time high levels in revenue. Like I said, the percentage of profitable companies has continued to grow. Growth rates are strong, right? 30 to 40% across the portfolio. Yet you haven't really had the catalyst to unlock that growth, because that catalyst, again, is tied to capital markets activity. And that's what we see taking place in the next year or 2 years.
Well, think about what happened in 2018, 2019, going into 2020, 21. So you had a big exit environment in 2018. You had a market shutdown at the beginning of 2019, and a completely closed exit environment because Lyft and Uber had kind of disaster IPOs at the beginning of the year. And you had a public market that was up 20 to 30% in 2019. So our fund, because the exit environment was shut and the valuation environment wasn't changing, was flat. So we spent the year building the portfolio, putting in good names. And people thought, well, they thought the same thing. Well, how can this market go any higher? Until, of all things, you had this pandemic that hit us in 2020. Nobody would have really thought that that would have been a catalyst for higher markets, but it was. And then you had the exit environment open back up, and we returned 25% in 2020, and then another 25% in 2021. So I think about this very similarly. We've cut the market down, our valuation in our portfolio by 50%. Back in 2022, we took advantage of dislocated pricing, though, so we ended up flat in 2022, while the market was down about 25%. Then we saw a rally, mostly large caps, in 2021, or sorry, in 2023, and we were down about 8%. To Eric's point, there was about a 6 to 12 month lag between valuations in public and private. And now you got 2024, where the public market is up really nicely. The smaller cap companies and those type of high growth companies, Russell 2000 type companies, are finally starting to rally, and we're 6 to 12 months behind. But we see this shift. We see it through dislocations getting better, secondary transactions starting to go up again, companies raising capital at higher pricing. Those types of things we see. We've been doing this long enough to see where this is going, and you'll see that reflected in our performance. But that's what I think Eric's referring to. Like, we're going to be catching up to the public markets, and hey, they can go higher in 2025, the public markets. But I think you're going to see a more of a slingshot effect in private valuations because they have a lot of catching up to do.
Do you want to speak to, I had heard that there's like 6 million private companies, and I don't know, the publicly traded companies is, I guess my numbers are off, like it's either maybe 4,000 publicly traded companies. So this is really where, there's a lot of companies, a lot of growth potential in this particular area. And it's, why don't you explain for a minute how you're getting access to these companies that people normally couldn't get access to?
Yeah, so to your point, like, that's been the big shift in capital. I mean, there used to be about 8,000 companies trading in the public market, and that's been cut in half. Now there's about 4,000. And we, some of the graphs we were showing at the beginning of the presentation shows the enormous amount of capital that's been shifted to the private space. So we've been doing this for a long time, and when we first started the fund, most of what we could do was only secondary transactions, where we're buying shares from an ex-employee or an early investor in the secondary market, where shares of private companies are bought and sold. A market that pretty much didn't exist, 15 years ago and before. This really started to develop when Facebook came about and started trading their private shares, and it put companies like SharesPost and Second Market and things like that on the map. So this secondary market is what's really evolved, and now it's $1 trillion market, just getting bigger. But that's one of the ways we get access to these companies, and we do them through the brokers that participate. So now the Goldmans of the world have secondary desks. So we talk to all of these guys. They know who we are because this is all we do. We don't buy public companies. We buy only private companies. So we get access to secondary transactions through a number of ways in that regard. We also, now that we're a $1 billion fund and we can cut checks anywhere between $5 to $30 million, we now get invited to primary transactions. So when companies go out and actually raise capital, that's something we didn't have access to for the first 3 years of the fund's existence. So we actually get invited to participate in these rounds because we have the cash. We have the cash on hand. We're not calling capital, and we have a network in the valley with the VCs, with the companies themselves. We've got 82 companies in the portfolio, so we're shareholders of all these companies, and we know a lot of the hedge funds and the crossover funds that might lead some of these rounds as well. And so we're going to get access and invitations to a lot of really high quality companies through that regard. And I think probably the third way, Steve, is just the companies themselves. The fact that we're on cap tables of 82 different companies. We know the C-suite in the Valley. A lot of these CEOs and CFOs that have gone from one company to the next over time, and we've been investors, they all know who we are. And so when they land at a really high quality company, and it's not something we have exposure to, in many cases, that's a relationship where we can actually use that to get onto the cap table of some of these companies. So we have a lot of channels that we participate in to get access.
Do you want to also speak to the percentage of how many companies that you have in the portfolio are in artificial intelligence, AI?
Yeah, if we have that sector breakdown, Eric, I mean, I can say, that's becoming a bigger part of our portfolio. We've been invested in AI for many years. So before it became sort of the popular buzzword that it is today, we've been invested in AI for a long time. Right now, it makes up 8.5% of the portfolio, but 35% of our companies that aren't pure AI companies utilize AI. So think about a company like Grub Market, which is a food technology company. It's not an AI company, but a lot of what they utilize is AI technology in order to optimize their businesses. So right now it's 8.5%, but 35% of our companies utilize AI. And you can expect that to grow a little bit because a lot of our AI companies are starting to blow up in the portfolio. I mean, we invested in XAI only 6 months ago, Elon Musk company, at $23 billion valuation. He's already raised very recently another round at a $45 billion valuation. And probably within the next 3 months, you'll see another round at a $75 to $80 billion valuation. So it's kind of crazy, but that's the kind of attraction and multiple you're seeing with these kinds of companies. And we're trying to grab a hold of a few of them and get in front of some of this stuff. But again, a lot of our non-AI companies utilize AI as well.
Yeah, so what you guys actually see here, this is our website. So we try to provide as much visibility into what Kevin and his team are buying directly, shares in the cap table of these private companies. And Steve and Kevin, I just want to make sure the audience can see what I've got here.
Yes.
Great.
Yeah, I can see it.
Yep. So this is the homepage. This is a really short, less than 3-minute video that kind of talks about why venture and the structure that Kevin outlined. This is what we kind of labeled the retail trifold, and it actually speaks to what Steve had mentioned, right? U.S. public markets are shrinking, companies are staying private for longer. Again, the term that we like to sometimes refer to as a unicorn, meaning the growth of private companies north of $1 billion valuation over the course of the last 10 to 15 years. But not only do the chart that I brought up before that shows a sector diversification, but here are the holdings as of 10 days ago, 11 days ago. So by buying this fund today, this is what you're getting immediate access to. This goes in order. So Grub Market is our top holding, not to be confused with Grubhub. I get that quite often. SpaceX, well, right now is our second as of 11:30. Nanotronics 3. If you are not familiar with any of these companies, you can click onto any of their icon, and we provide a quick paragraph as to the underlying business model. Something that I like to utilize is I just showed you this pie chart, but furthermore, if you've got a particular interest in gaining access to aerospace, well, you can click any of these pieces of the pie chart. I clicked aerospace. Here are the 7 aerospace companies that Kevin and his team have invested into and are currently invested into. So alongside of SpaceX, Beta Technologies, Relativity, Axiom Space, who's basically won the government contract to build the new International Space Station, as well as build all the new NASA spacesuits, right? So while we love SpaceX, there's a lot of other really exciting space and aerospace companies also out there. So I hope that's helpful as a way to just get comfortable with the portfolio and knowing what you're buying.
Kevin, do you want to explain your process as to how you pick the various investments in here and how you look to the big players in the market, the venture capital people, the so-called smart people in the marketplace to go alongside them, and why that's an advantage to investors?
Well, it sounds like you're
sure.
capital now.
What's that?
It
Go
sounds like
ahead.
you're a VC now, or able to
Yeah,
be,
well, we're not a VC as they are. Like again, we're not coming in at the very beginning, but we follow them. And Eric, there's a slide that shows that in the
Yep, I got it.
presentation. We're invested alongside, you can see right here, Excel Partners, like 17 of our companies, Excel is invested in as well. 13 Andreessen, IVP, you got 10 Sequoia, which is arguably one of the most successful VCs in the world. 10 of our companies they've invested in as well. Our process is, we probably see about $10 billion in deal flow a year, just from all over the place. Some of it's through our VC friends, some of it's through brokers, some of it's through bankers. We get approached directly by companies. I'd say 50% of that $10 billion in deal flow just isn't high quality deal flow at all. And we kind of push it aside. Maybe $3 billion of that deal flow is pretty good deal flow. But we, of course, have only a certain amount of capacity in terms of portfolio construction. And 2 billion of that deal flow is like really high quality deal flow, which we're going after. Some of that, Steve, is, we can get a call from Excel Partners that's raising capital for a company that is a very high quality company, not very difficult to get access to. And they're raising, call it $250 million. They're leading with $100 million check. And then they have people like us fill up the rest of the round, something like that. And so we'll get that call, or we'll get the call again, like directly from the companies themselves. And we'll see a lot of this deal flow. Our process is, looking at a whole bunch of different factors, but very high level. We want to see, a certain amount of revenue, $50 million or more at least. And as we pointed out, there's companies in our portfolio that are doing hundreds of millions, if not billions of dollars in revenue. We want to see at least 30 to 50% top line growth. Some of our companies are growing much higher than that. We want to see a view to profitability, so we talked about that earlier. They don't have to be profitable. Most of them are not. Some of them are. Grub Market's a profitable company. Upgrade is a profitable company. Like, it's great if they are, but they certainly need to have a view to profitability. And then going back to, these VCs, like, we want to see strong VC backing, not just initially, but subsequent rounds of financing. We want to see the VCs continue to support these companies as they grow and sit on their boards and have the governance in place such that we know that there's, that they're being monitored. Because we've seen, of course, over time, some of the high profile disasters like WeWork and FTX and others, really high popular companies, but not very good governance.
So when do you see returns on the companies that you've invested in?
Well, so you're going to see unrealized returns get reflected in our NAV as the companies grow in our portfolio, and based on our valuation framework. An example of that is SpaceX, right? They just did a $350 billion round, which we talked about earlier. Well, that's going to be reflected in our performance at the end of today, actually, because we have to mark that up. And so you'll benefit from that. And that's going to be in your performance. And if you sold in a redemption, you're going to get that higher price. But then, of course, at the end of the day, what we really want is these companies all to have a liquidity event, whether it be an IPO or an M&A transaction, and realize our gains, which we've done over the years. Obviously, when you have an active exit environment like we saw in 2018, 2020, and 2021, we see higher realizations, or if you have a very active M&A environment, and that way we realize our gains, and we move on to another investment. Our gains that we realize, the appreciated amount, we end up distributing back to our shareholders. You can either take cash in that regard at the end of the year if we make a distribution, or you just reinvest it back into the fund. And we find that the majority of people actually reinvest back into the fund.
Do you want to, I think Eric had showed me some slides that showed how the growth and the valuation of the companies in here compared to the publicly traded markets, just so people can get an idea of maybe the opportunity.
Well, yeah, I mean, I'm not sure which slide he's referring to, Eric, but I mean, think about it like this, like, our fund is up, our fund, like on the downside, the market was down in 2022, 25 to 30%. We lagged 6 to 12 months. But we also did a lot of things in our portfolio to try to help our returns, but we were flat in 2022. Things caught up with us in 2023 in terms of the valuation environment. We were down 8%. At the same time, the market's now recovering, right? And not as only recovering, but coming into 2024, you're hitting all-time highs. Yet here we are at 5.5%. We'll probably tack on another 4 or 5% before the end of the year. And we think that we have anywhere between 40% embedded value on a base case scenario based on the embedded value in our portfolio companies, probably 40% to the upside. And if it's a really healthy exit environment, in a super bull case, we think we could be up over 100% over the next couple of years. So that's I think where we sit based on where the market is and where the public market is going. And again, an example of that is like Motive. Samsara is sitting there trading at a 27x revenue multiple, and we're holding Motive at a 6.5x revenue multiple. What's going to happen when Motive goes public? I mean, I don't have a crystal ball, but I'm
Probably
quite
won't be at a
confident
6x.
it's not going to be at a 6x, even if it's at a 12x, which is twice as much, and it's still almost half as much as Samsara. I mean, that's a $30 million P&L bump for us just in that position alone, because it's our fifth largest position. So, it's stuff like that, Steve, where I think the opportunity lies in this portfolio.
And X means times, by the way, to people on the call.
Yes.
Earnings is what we're talking about there too. So, okay.
Correct.
What kind of ratio do you have between cash and investments that you want to try to maintain so that you've got the ability to write these big checks for things?
Question.
We always try to keep 10 to 12% cash in the portfolio. That's how we've been running the fund since inception. We have to keep by regulation at least 5% for redemptions. And then we have another quarter of cash for a rainy day, like if we see something super compelling, or if we get into a stressed market, we want to make sure we have at least a couple quarters of cash for redemptions. And we feel like that's been a really healthy level for us, as it relates to an illiquid asset. We never want to be in a position where we run out of cash and we have heavy redemptions and we're forced to sell positions in order to generate cash, because what happens when you're forced to sell a liquid asset, it's not good news, right? So yeah, we want to avoid that. And so far in 11 years, like, we've done a pretty good job. We've never been in a position where we're forced to sell a position. The only time we sell a position, and we have done quite a bit in the private market, is one, if a position's not doing well, it happens. We're not perfect. We will try to exit that position, but it's not that easy, and we'll never sell it at a discount. We'll just keep it where it is and monitor the position. And sometimes it gets diluted in the portfolio, and then comes out naturally over time. But the other side of that is company that is overperforming and has grown dramatically in the portfolio, and then we're just taking chips off the table because we're still trying to wait for a liquidity event, but we're not also sitting on a 5 to 10x return, and we want to do proper portfolio construction and not be stupid about it. So we've sold Palantir while it was still private, but kept a big part of the position for the public market. We sold Lyft because it became a 15% position in the portfolio. It just grew so much in our portfolio. We cut that down. Even SpaceX, we sold our cost basis about a year ago, and it's still a $70 million position, but we were sitting on a 6x return already. So we took our cost out, we sold it easily at a good price, and now we're still sitting on a $60 million position, which is about to turn into about an $80 million position.
Okay.
Does anybody else have any questions?
I've been hogging it.
Or Brian could ask another question, I guess, if he wants to, though.
Why are there three companies listed on the exchange?
3 companies listed on the exchange. What
I,
companies do you?
I think, Joe, what you're looking at is there's different share classes you could buy into over here. I think
Oh,
that's what
yeah.
your question is. There's a fee-based one, there's a commission-based one, and then I think there's a one in between that then too. I think that's
Okay.
what you're
Yeah.
looking at.
That's the
Okay.
fund itself. So none of the portfolio companies are public at the moment. We had one exit this past year, which was Rubric. One exit in the last 3 years kind of underscores the closure of the public market. But yeah, you're looking at the fund itself and the different share classes that are listed.
And that's the thing is you could look at this right on your phone and type in PIIVX and you could see the performance of it really literally every day on there then too.
Yeah.
Do you also want to talk, Kevin, about when you sell these shares, like when it goes public, how you no longer hold it? Do you want to speak to that?
Yeah, we're not the strategy is not one that we take a view on public companies. So the strategy is buy private, hold them for anywhere between 2 to 5 years, have them mature in the portfolio. And really the goal is to make 2 to 3 times our money in a 2 to 5 year period. That's like our goal. If we hit our goal on average, we should annualize, call it 15 to 20% over time. And with half the volatility that you see in the public market. So when a company does go public and it's an exit, and we're going to look to realize that gain. Most companies that go public, as I'm sure you're familiar with, there's usually a 6-month lockup. So anybody that's invested in that company in the private space is locked up for 6 months. Once that lockup comes off, we're actually going to start looking to exit that position at that time. Now, we're not going to sell it all on day one, but we're going to sell it sort of methodically over the 30, 60, 90-day period after it comes off of lockup expiration. And at that point, we'll realize that gain, and then we'll move on. And that, I tell you, that really allowed us to massively outperform the Tigers and the SoftBanks of the world, because when the market started rotating in the summer of 2021, I mean, we were out of most of our public positions that had gone public, and companies like SoftBank held on to SoFi, for example. They were the largest shareholder, watched it go up into the mid 20s and all the way down into the mid single digit numbers. And so that's our strategy, for better or worse. We've seen companies take off to the upside at some point, and but we're on average, I think that has really worked out for us.
Yeah, and one of the other things is like how your fund works in like an overall portfolio, like how it kind of zigs when the market zags. Do you want to speak to that a little bit?
I mean, I think there's an enormous, over 11 years, Steve, there's a lot of shareholders that have been with us for a long time. And one of the things that they like about our fund, outside of absolute returns, is the uncorrelated nature of this fund, and the fact that the fund holds up really well in periods of times of financial distress. We have a study that shows that like 9 out of 10 times, the worst drawdowns that you've seen in the public markets, we've outperformed 9 out of 10 times. Not just outperformed, but by a significant amount. When COVID hit, and the market was down 15 to 20% quick, like, we're not going to be down 15 to 20%. We were down like 3. And you can see that, in 2022, when the market was down 25%, we were flat. So you're going to see in periods of distress, we actually hold up really well. And a lot of shareholders like that, that's obviously a big deal to them. And they kind of don't have to worry about us in that regard. Now, are we going to be up in 2024, 25 to 30% where the public market is? No, not necessarily, but we could be next year. We will probably end up catching up. So it works both ways, but the volatility of the fund itself is half the amount of any public market. And that's been something that our shareholders have really appreciated.
Yeah, I think it's what you just said, right, Kev, the lack of correlation, but then again, just to highlight the ease of structure. Historically to invest in the companies that we've highlighted today, you need to be accredited at QP. They had $100,000 minimums, $250,000 minimums, if not higher. You're getting a K1. You're locked up with absolutely no liquidity option for 5 or 10 years. I think Kevin or Steve mentioned kind of the 2 and 20 hedge fund fee structure. So you're paying kind of a 2% management fee, but layered on top, they're taking 20% performance fee. With the private shares fund, the structure eliminates all of those headaches, right? So again, you buy this like a mutual fund. There's the share classes available. Because you guys are investing through Steve, the minimum across all share classes is $2,500. So it's much more accessible than having to cut the big check like in traditional private equity or venture capital. It's a 1099 vehicle, so you don't have to worry about K1s. We've highlighted obviously the liquidity, and there's no performance fee, right? There's no carry. So I think it's important when you're thinking about why investing in this asset class, but also, hey, how do I actually do it? That's where the vehicle, from my experience in working with Kevin, a lot of clients have looked favorably upon.
I have a question.
She said, look, do you have institutional holders, or is it primarily retail of your funds? Or is there a percentage of institutional holders?
It's primarily retail, but we do have, I mean, there are hedge funds, a couple institutions that have bought our fund for the same reasons that anybody else would. Like they just don't want to go, they don't want to be locked up for 10 to 15 years. So we have a few of those in the fund, but the majority of the fund is large RIAs, financial advisors. That's the majority of this fund.
Do you want to speak to the liquidity of it? I know it's quarterly liquidity up to 5% of the outstanding shares, but how often has that like restricted people from getting their money out if they wanted to?
Well, in the history of the fund, for probably the first 8 years, we never even breached the 5% cap. But when things get difficult and you have COVID and things like that, and people are just going to cash, you're going to breach the 5%, which we've done. We've breached the 5% like any other interval fund, and then a quarter or two later, we've gotten full liquidity. The last year and a half, since our sector in particular has been very challenging, we've been breaching the 5%. But unlike traditional venture and private equity, where you have no liquidity for 10 to 15 years, we were still returning anywhere between 35% all the way up to 95% of a requested redemption. And then if you wanted to continue to redeem, like you would do it the following quarter. So we've been able to get full redemptions in a very illiquid asset class within, call it 3 to 6 months, as opposed to traditional venture, which is 10 to 15 years.
Okay, anybody else want to show their face or just anonymously ask a question? Feel free. Well, we can always have Brian ask more questions.
Well, when you were talking earlier about how the companies are staying private longer, if they've got access to capital during this growth phase, that middle growth phase that you're looking at, what's usually the key that wants them to go public, essentially to jump off that cliff? Is it more capital that they're looking for at that point, or?
Well, so it's a couple things. One, we only invest in primarily venture-backed companies. So if you're an investor in a company, especially a VC, if you're getting money from that pool of capital, you have to provide an exit for your investors, whether it be an M&A transaction or an IPO. So that's like set one. Like you can't just stay private forever because you have all these investors that have helped you get to where you are. You need to have a liquidity event so that's number one, and that's why we stick with primarily VC-backed companies. But two, being a public company, you have a public currency. There's a lot of other things you can do as a public company that you can't actually do as a private company. And so there are companies that want to eventually be public because of those additional things, even though it comes with other negative things that Eric alluded to in the beginning with quarterly earnings reports, the ability to short yourself. So they're going to go public because they get one big pop in terms of a capital raise, but they have to be public ready companies for you to enter into that phase. And then there's things you can do that you can't do as a public company, especially having a public currency to be able to do transactions with.
But the other part, Brian, is that a lot of these companies don't go public. They actually get bought out by bigger companies. So that's most of the mergers and acquisitions where that's the other part that's important is that, with the new administration, there might be, less antitrust and less regulations and things like that. So a lot of deals might be happening because of that as well. I think it was like
Exactly.
two-thirds of the funds will
Yeah.
probably
Yeah, exactly,
go
Steve. I
the
think
M&A.
IPOs tend to make the big headlines, right? But when you actually look at kind of the venture ecosystem or the private innovation economy, about 2/3 of all historical exits have actually been M&A driven as opposed to IPOs. So a lot of the companies that we target, many of them will never become publicly traded entities, right? They get acquired by the Googles, the Amazons, the Microsofts of the
That
world.
are already public.
Right.
Okay.
Yeah.
I know we've used a lot of complicated terms over here and things. So if anybody has any questions about the fund and how it works and all that, just feel you can always ask me later, or I'll reach out to you and we can talk about it. But does anybody else have any other questions? I'm always impressed by the time that people stay on these calls because I would have thought 20 minutes, we would get it done. But here's an hour later and people are still with me. And I guess if Brian asked 20 more minutes of questions, I think people would stay on over here then too.
I think I'm done.
They're done. And I think I'm done too. Does anybody else have anything else that they want to ask and go through? If not, thank you, Kevin. And then at some point, Eric, I think we will try to do, get together in person and we could, except for you, Brian,
Yeah.
and Kevin, as we won't be able to do that, but
Hey.
everybody else.
Having
get
to
together in
come
person.
down from New York in the winter to Florida in the winter,
Yeah.
pull my arm too
Sounds
hard
good
there.
to me.
Yeah.
Yeah, I think that'll work for that then too. But if nobody has any other questions, thank you everybody for joining us, and we will we'll let you know when the next event is.
Thank you, Joe.
Thanks, Steve. Thanks, everybody.
Thanks,
Happy
everyone.
holidays.
Thanks,
Okay.
Steve. Thanks,
Bye
Kevin.
bye. Bye. You're still there, Brian? Oh, he left. Nobody wants to show their face. Okay.
So,
Do you have a question? TL, I'll see you at trivia soon.